big gains right now in this market. Go to trendtrade.com and order now.
Welcome back to Squawk Box here on CNBC, First in Business Worldwide. We are now 1 hour, almost exactly, from the opening bell. Our guest host today is Wilbur Ross. He's the chairman and CEO of W.L. Ross & Company. And we have a co-host, Amanda Brewer.
Yes.
Yes, that's me.
CNBC Asia.
From CNBC Asia. CNBC Sydney. CNBC Australia. Let's get our nomenclature correct. Otherwise, I'll be wrapped over the knuckles.
Descended from a warden, not for, in case you were wondering. We talked about.
I'm the whipper, not the whippy.
Yeah, exactly.
And if you're in the Port of Sydney, you can find the Denison.
The Fort Denison.
Fort Denison.
It was named after that governor of the penal colony of Tasmania, who was my great something, according to family
governor
folklore.
Of the penal colony. That's probably true. They wouldn't make that up, would they?
I don't know. They might. You know, they can flash it around at parties. Pick up. It's a good pickup line.
It is.
It's
and you do a lot of picking up. Yeah.
Oh, yeah. Very married with 2 children. A big week for economic data coming your way as the first half of 2009 draws to a close. We have Rick Santelli and Larry Levin of secretsoftraders.com at the CME Group in Chicago, and also CNBC senior economics reporter Steve Leisman. Gentlemen, thanks very much for joining us. Why don't you kick it off for us, Rick?
Well, I think it's going to be an important week for so many reasons. We see that interest rates have moved down for portfolio adjustments, duration adjustments. You know, one of the unintended consequences, whether it's good or bad, it's your own interpretation of the Fed asset purchases, has been to shorten duration. What does that mean? Quite simply, to make the portfolios of many fixed income entities have a shorter maturity, they behave like, and to appropriately adjust. There's end of the month, end of the quarter, end of the half year buying. Maybe part of that's over, but it's worth watching, along with, of course, jobs report going into a holiday weekend.
Yeah, absolutely. Talking of that jobs report, the mother of all data, Steve, on the economic side, what are you seeing there? What are people saying about what kind of numbers we can expect and what it'll mean for the economy?
You know, most people are calling for pretty weak numbers, but kind of saying that it could be even weaker than they think. I think the bottom line for the market's going to be is that we've settled down, hopefully, into this area that is about half of what it was, from the -6s and minus possible 700,000 down to between -300 and -400,000, with that unemployment rate creeping up towards 10%. But let's face it, you know, the news basically, as we reach the end of this quarter, is boring, and that's sort of a story here. I thought the most interesting story in Barron's this weekend was just about guys going in from longer dated options down to shorter dated options. If that's the most interesting story, then you know things are boring. And that's important because, as Rick said, it's the end of the quarter. If we get through this in a boring way, we're in good shape.
Yeah. Do you think we're going to see a little bit of window dressing, though, Larry? That normally happens at the end of a quarter, doesn't it?
Yeah, it does, and I think a low-volume week like we're going to see this week as we go into this holiday will also push these markets up. These markets tend to move higher on low volume, you know, before a holiday week. I am kind of surprised that we still have the unemployment number on Thursday. You would think we'd want to push that back to a week where there's going to be more activity here, but they're not doing it that way. Maybe that's a sign that the number's going to be even worse than expected, and we're trying to do it quietly. It wouldn't surprise me at all the way things have been going. This market continues to be propped up by government intervention and manipulation, and unfortunately, as that continues to happen, I think this market can go higher. The government's been doing a good job of keeping it that way, no matter what the real underlying current is, unfortunately.
Then what happens when we go into the second half? Is reality going to hit in a bad way?
You know, if the government can keep, you know, putting all these IOUs out and printing money, I guess not. I would have said the first 6 months, many professional traders down on this floor would have told you the same thing. This market should not continue to move up the way it's had, move up 4 months in a row, basically. But that's what it's done, and really, you know, you're going to have to pin it right on Obama and his staff as basically trying to prop this market up on a daily basis. They're doing a good job.
It's worth to point out, though, that interest rates have come down in a week after the Fed really suggested it wouldn't do anything more in the way of the quantitative easing. It left its policy in place and didn't extend it or do anything too much dramatic there. And interest rates seem to have come down on their own some, just as they seem to have gone up on their own some.
Wilbur?
Well, there are market forces, in place that are moving these markets. Supply and demand certainly affects traders that have no underlying, interest other than making money on these particular trades. But it really is a situation where every single day we have some kind of backstop from the government. I mean, these markets are not free markets anywhere. This whole year has just been absolutely ridiculous, and I don't know when it's going to stop. But as far as I'm concerned, this continues to drive the market higher. It will continue, and I don't see any stop.
Did you send him talking points, Rick?
Well, I think Larry's doing a darn good job. I tend to agree with most of what he's saying. As far as the optimism of rates moving down after the Fed statement, there's a lot of forces at work. I would just suffice it to say that the asset purchase program has created 2 or 3 extra helpings of volatility. And like uncertainty, volatility sometimes is an unappreciated characteristic.
Wilbur, weigh in here.
Aren't we facing an environment where Washington is the new Wall Street? It seems to be no capital transactions get done at all without some sort of intervention from Washington. And I wonder, how do we ever get off those vitamin pills?
Well, we have a lot of places in history, Mr. Ross, where, oh no, excuse me, we don't. I think the best model for what's going on now, truly, in every fashion, whether it's healthcare, whether it's cap and trade, viewers, look at Fannie and Freddie over the decades. It's a business that was in a proper business, sort of, with a government charter, and they had huge impact in the decision-making, and ultimately, the presence of the government skewed pricing, and we are living with the aftermath of that. I think that translates well into any business the government gets in.
I think that overstates it a little bit, Rick. If you want to go out and do triple-B mezz financing on credit card asset-backed securities at 9, 10, 11, 12%, you are absolutely free to do that. What the market is saying, essentially, Wilbur, is that it's not going to get any of that done at that price.
Then maybe we shouldn't be doing it, Steve.
Well, maybe we shouldn't. Maybe people should be able to should not be able to get any credit at all on their credit cards.
When you commit many sins, the ultimate end is that there has to be some type of healing process. And as much as I think the Fed and the Treasury are moving in a way to make it heal, what they're doing is pushing it forward. Yeah, and they're real excited about that in Washington while they spend all this money in the consumer saving.
It's not really healing if you're just transferring liabilities from private sector to public
from one
sector.
balance sheet to the other.
Yeah, we've got to leave it.
There is absolutely no healing. No healing at all right now.
Sometimes a little bit of pain is not a bad thing. Gentlemen, thanks very much for that. Rick, Larry, and Steve, and of course, Mr. Ross, who is staying with us as our guest host.
Checking the futures this morning. A little bit of positive action, even though Asia had some red arrows overnight. There's a look at futures right about 10 points or so, I believe, above fair value this morning. We'll see where we go on this first day of a holiday-shortened week, as Rick pointed out. When we come back, a CNBC exclusive, Jim Lockhart, director of the Federal Housing Finance Agency and regulator of the aforementioned Fannie Mae and Freddie Mac, will be our special guest. We'll talk about all those issues that we just were chatting about, and we'll get an update on the state of mortgage lending and how some of these modifications are going. And Squawk Box continues.
Why toss out your money? Switch to Sprint. Save $475 a year with the Simply Everything plan and get the BlackBerry Curve 8330 smartphone for just $49.99.
Some things in life need to be precise. Investing is one of them. That's why State Street created Spider, a family of ETFs designed to please even the hard-to-please investor. Before investing, consider the fund's investment objective, risks, charges, and expenses. Contact 1-866-787-2257 for a prospectus containing this information. Read it carefully.
Companies that want brilliant color are moving to EcoSys printers from Kyocera. Companies that need crisp black and white are also making the move. Companies that are smart about saving money are making